you. So welcome to today's tax panel. We're going to be discussing the importance of tax due diligence and how it can be utilized to optimize transaction structure. My name's Nichol Chiarella. I lead the M&A tax practice at Citrin Cooperman. Citrin's a full-service tax advisory and accounting firm. We specialize in transaction services. Our panelists today are going to be sharing with us real-life examples of how tax impacted deals and how they were able to take action and optimize their position. So we'll kick it off with some intros from you guys. Sound good?
Sure. Hi, I'm Nick Barker with Longhouse Partners. We are a Detroit-based independent sponsor firm. We've been around for about 6 years under this format as independent sponsors, and have completed 3 transactions. We spend time in business services, consumer, and light industrial markets all across the U.S.
Hi, I'm Andrew Ferworn. I'm a partner at Virtus, and we're an insurance broker. I lead our team's private capital insurance practice, working with private equity firms, independent sponsors, family offices, strategics, other investors on really a full gamut of insurance needs, so pre-close due diligence, so assessing insurance risk and go-forward strategies, placement of coverage and ongoing brokerage work across commercial property and casualty and employee benefit insurance, and then, of course, transaction-related insurance items like reps and warranties insurance, tax, and contingent liability.
I'm James Illikman with Peninsula Capital Partners. We're a committed fund capital provider. We've been around for about 29 years. We've raised 8 funds. We've been committed to the independent sponsor space for almost 2 decades now. We've completed over 70 independent sponsor transactions. And our strategy is to provide the whole bottom of the balance sheet. So we want to provide all the equity necessary for the transaction and all the mezzanine. Sometimes we're a minority, but the majority of the time we're a majority capital providers because we have the balance sheet to support the independent sponsor.
Hi, I'm Grant Kornman. I'm a partner and co-lead at Align Collaborate. We're a relatively new investor in the space. We launched right after this conference last year. We invest anywhere from $10 million to $50 million of equity solely in independent sponsor transactions. Love the lower middle market, so companies with 2 to 15 million of EBITDA is a great fit for us. Last year at this conference, I was still wearing a white lanyard. We were a longtime independent sponsor who recently got into the investor side of the business.
Good morning. I'm Jason Duzan, Colfax Creek. After 20-some years of institutional private equity, I went to independent sponsor world about 8 years ago. I've had 2 exits, have 4 companies today. As I've told people, you buy one manufacturer and you end up with 3 more. They just show up. So primarily a little more of industrial, old economy type strategy. And the brand of independent sponsor, I somewhat tongue-in-cheek call myself an undercapitalized family office. So we have kind of a long-term perspective. We don't take a lot of institutional capital, but we don't have a lot of money either. So we have to, we go talk to mezz and senior debt to fill out the capital structure.
Awesome. Thank you. So we'll kick it right off with a question on tax due diligence. And what type of tax issues have you guys uncovered during tax due diligence? And the second part of that question is, did that potential tax exposure ultimately change the way the deal was structured?
I'd say the most significant issue that we've encountered has been a questionable S-Corp election. And the most common issue that we see is lack of sales tax and income tax nexus compliance. And the first one has caused additional due diligence, but we've never had a deal where we couldn't ultimately confirm and get comfortable with it. But we had numerous cases on sales tax where there's been extended negotiation, extended due diligence, voluntary disclosure processes with various states. But I would say at least half of the deals that we've done in the last 5 years have had some level of sales and use tax and income tax nexus lack of compliance.
I'd second that. We've seen a sales tax issue in a number of investments, and frankly, it's really cheap to do the diligence on it, and tax kind of gets left to the end. And so I'd really encourage independent sponsors to move that up in their diligence process if you think it could be an issue. It can be very expensive to try to hash that out late in the game, close to a closing.
Yeah, and the interesting thing is, lots of times we hear, oh, it's an asset deal, don't need tax diligence. But when it comes to sales and use tax and what we call trust taxes, right, they're fiduciary. And so even when there's a nice hold harmless list there in your reps and warranties, the state doesn't care. So the state is still going to attach itself to that asset. If you've purchased essentially all of the assets of a company and you've got sales tax or payroll tax exposure, they will attach themselves to that. So a nice workaround to that could be the VDA, if you guys have done some of that. And so a voluntary disclosure agreement whereby, you get to limit that look back period to 3 years and also waive penalties related to any unpaid tax and unfiled returns. I will say the one thing about a VDA for anyone who's had to go through it is like it could be a 3 or more month long process, right? So first you've got to apply to get into that VDA program. The response from the state can be anywhere from 1 day to 30 days. Then you've got to register. And then, of course, once accepted, you've got about 3 years worth of tax returns that have to get prepared and filed. So, Andrew, I'd be curious to see what's the role of insurance when there's a VDA as part of a transaction.
Yeah, and I'll answer your question with a question kind of to the audience first, which is how many folks are familiar with reps and warranties insurance? And then keep your hands up. How many are still familiar with tax liability insurance? So yeah, it's kind of interesting. So I'll kind of kick it off first with a bit of an introduction on that insurance product, just to get everyone familiar and up to speed. But it's a mature product. It's been around for 15 or 20 years. But I think with the backdrop of increased M&A and private equity deal activity, increased tax uncertainty, and then increased reviews by tax authorities, and I'm going to use the word tax authority because it's a product that spans multiple jurisdictions. It's not just left for the U.S. It's a insurance product that's been growing from a market size perspective, 20% year over year compounding. And so over the last 3, 4, 5 years, folks are catching up to what this product is and how it can be used. And so just as a little bit of some awareness, to help with questions and how this can apply. It's a product, you have to think of it differently than you would think of reps and warranties and how it handles tax, right? So reps and warranties is pre-close items and they're unknown risks. The tax insurance policy is designed to cover known or unknown risks, and it's specific to tax that has subjective interpretation, has a material implication to it, and by material, I'll specify like these are insurance products that are geared toward liabilities that might be $1 million or more. And then the other aspect of it is that there is some certainty around them, right? So that it's not a known risk that you're asking the insurance carrier to, hey, take this. We don't want it. That's understood, but it's instead meant to cover kind of the what if of what this looks like. And I think the way that we phrase it is the right side of risk. So more likely you've done things the right way, things are in good shape. But to Nicole's question, when there's a VDA, obviously you've uncovered a known issue. And as you're going through that process, there is still some exposure there of, as we kind of define what that liability looks like, where insurance can kind of play and kind of fit in to cover liabilities that may emerge following this exercise. And so I think sometimes people get to this stage and they think, okay, well, it's known and we're kind of at this point. There's no role for insurance, but its place there is that it can cover continued costs for legal defense, taxes, the tax itself, fees and penalties that might be assessed after the fact, post VDA.
Guys have anything else to add on the non-S Corp issue? I will say S Corps are tricky, right? And we see them all the time in lower middle market. So it's certainly a massive area of diligence. And, as a reminder, for an S election to be valid, first, you've got to have a timely filed S election, right? There are relief provisions. So, okay, we've got a late filed election. They can file for late election relief and provide what's called a reasonable cause statement. That statement's got to have certain elements for it to be accepted by the IRS. So we saw this target once, and a couple of people started an LLC. They got out of college. They said, let's start a tech company. We'll form an LLC. Cool. And then about a year or two, when they realized they had to file a tax return, they went back to their college tax professor and they said, hey, what kind of entity should we be? And the professor's like, oh, you guys should have been an S Corp. Get out of SE tax. And they were like, oh, okay, so let's do that. Oh, it's too late. That's okay. You can file a late election. So they filed the late election themselves. And the reasonable cause statement was, we're a couple of college guys, wanted to start a tech company. We relied on our college professor to do that. The IRS did not accept that. We did have to structure around that on the buy side, but it was certainly lots of fun to read. Okay, and so another question I've got for you guys is, how have you been able to historically structure deals to take advantage of a step up when you've got a corporate or LLC target company?
I can jump in. And also I'd add the S Corp, right? There's a lot of flexibility. A lot of founder-owned businesses have S Corps. You're going to fact check this here in a moment, but a lot of flexibility with structuring those to get a step up with 330H10 or F reorgs. Well, I don't know, go into that too much now, but and then with the C Corp, there's not much flexibility. And back in my private equity, institutional capital, ultimately you had a C Corp blocker almost consistently. And then you kind of moved to the LLC structure as independent sponsor. And now I'm back to C Corp structures with like 1202s and qualified small business we're going to. But the step up is really important to, I think, independent sponsors, particularly those with longer time horizons, because you get, if you're selling this in 3 years, the step up, you get a couple years of lower taxes. But if you have a longer time horizon, it's a big deal. And so, one of the things we do, particularly with S Corps, LLCs, is we really price in a step up, and particularly with family-owned businesses. And so they're going to quickly go there. They're going to say fine. And then they're going to quickly talk to their tax accountant. It's like, whoa, because you have all this particularly bonus depreciation you've been taking over the last tax regime, and so you're going to have a big ordinary income bill. And then we talk about it, and then the step up is very important to me, as because if you don't get a step up, whether it's 15 years or which is the tax depreciation or the step up amortization for that. That's very important. So even if I don't get the 7-year, which some of these PP&E and fixed assets, I still want the 15-year. So I'll go back to them and say, hey, I'll let you when we do the purchase price allocation. So when we close, we do a purchase price allocation. I will agree today to make the fixed assets equal to tax basis, because that's really their step up issue, is really just this bonus depreciation, this depreciation of tax depreciation accelerated. So they usually, oh yeah, that's fine. That solves, Nicole may fact check me here, but that pretty much solves their problem. And so we're able to get a step up. It doesn't harm them too much. I still get the ability to amortize that goodwill over 15 years for tax purposes. Could have been a little better if it was 7 or 5 or whatever the fixed assets are, but still pretty good for me. And with a longer time horizon, it's very valuable. So that's kind of one thing we've been doing. It's not rocket science, but it does kind of help bridge that gap with the seller who, particularly, go back to my industrial, a lot of CapEx. It's a bigger deal for them.
In the case of a shorter term hold, it could also be advantageous to you when you're selling the business, because those assets the company you're selling with the assets has basis, so the next owner can get the benefit of the depreciation. But there is one exception that we have found, is when we're selling a company to a fairly large publicly traded company, they really don't seem to care. They care about earnings per share, and they care about whether the transaction is accretive on an earnings basis relative to how their stock is trading. While they should care for the benefit of their shareholders to get all these tax deductions and ultimately improve the cash flow of the business, we have found that universally public companies buying our portfolio companies do not care about getting the extra step up, which has been quite surprising to us.
Yeah, and the only thing I'd add, because you said it really well, I don't think you need me to add to that, but with the new pass-through entity tax regime, so at least 34 states now offer this pass-through entity tax, and it's an entity-level tax you can elect into. So that pass-through entity, whether it's an S Corp or a partnership, can elect to be taxed at the entity level. And then there's a corresponding federal deduction that flows through to the shareholders or partners, and an offsetting credit. So they're going to get a deduction for a tax they would have paid anyway at the individual level by electing to pay it at the entity level. And what that that does to a gross up is it really minimizes what it can be. So depending on, of course, the state that the shareholders or partners are in, of course, if they're in a non-income tax state, still going to have a nice gross up for them, unfortunately. But if they're in an income tax state, and even in cases where they've been on the cash basis instead of accrual, depending on how that purchase price is allocated, which I'd like to hear a bit from that from you guys on that as well, you can end up with a gross down. So sometimes what we've done for sellers is they're like, oh, I've got this LOI. And they want it to be an asset deal, so we're gonna talk about a gross up, or I'm not interested in that deal. And we're like, hold on a minute, let's model this out. It actually, at times, is more beneficial to do a deemed asset sale, which is that F reorg and that 338H10, when you have an S corp target and you're the purchaser, and then again, really minimizes the gross up. So sometimes it's a bit about educating the sellers and their advisors. If they don't see it a lot, they just hear 338H10, and historically it's always meant major tax hit, or they hear F reorg and they're like, no, that sounds bad and complicated. But just educating them and letting them know, hey, like, good M&A advisors do these things in our sleep, and it's really not that scary once they can kind of understand it a bit. And so what do you guys think about purchase price allocation? Are you really focused on that during the drafting of the agreement? When do you start to focus on it?
Unfortunately, always too late. I think.
Amen.
Yeah. So I guess that's a word of the wise that it tends, in my experience, it's come up at the 11th hour. It becomes an issue at the 11th hour when you're not trying to create new issues. It can be very impactful to the sellers in a lot of cases and the buyer. So I just another one. I feel like all of these anecdotes end up do this for further ahead in the process. I think unfortunately, as this side of the dais as non-tax people, it's not as top of mind as it should be. So call Nichol earlier than later.
Yes, there's no such thing as too early, we always say on the tax side, but it's true. Purchase price allocation, when you have, even if it's an equity sale legally, but a deemed tax or asset sale, for tax purposes, drives the entire tax implications and therefore the economics of the deal. So to your point, James, right, driving more of that purchase price into shorter lived assets can be great. There was someone I remember mentioned they've actually used a tax basis to allocate purchase price. So I guess high level purchase price allocation, when you have a deemed asset sale or purchase for tax purposes, you've got to allocate that purchase price across 7 different asset classes. And some of them are shorter lived, they're AR, your prepaids, your 5-year equipment, 7-year, et cetera. And then the rest kind of gets dumped into goodwill over and amortized over 15 years. And if the seller's been on the cash basis, they're going to have a lot of ordinary income as opposed to capital gains treatment that they have to recover on those shorter lived assets. So they all want everything pushed down to goodwill, or even better, hey, allocate it based on a methodology that uses tax basis. Buyers, oftentimes we see a methodology for net book value, which would be preferable, right? But again, it's all negotiation, who gets what, who wants one. And if you're willing to pay for a step up, or even better, step up's not that bad, you could get your great step up using net book value or the balance sheet on the date of closing as a methodology, as opposed to tax basis. But yeah, we like to start talking about that. Once that purchase agreement gets drafted, literally one of our first comments is going to be, let's start talking about the purchase price allocation methodology. So we don't have numbers. We won't have that until 90 days post-close. But agreeing on that methodology so that we're not dealing with it after the fact, or to your point, closer to closing.
We've even found some sellers that have been a little easier to deal with on the purchase price allocation at the LOI stage, where they're focused on kind of the headline number of the transaction, and they're maybe a little less focused on what the tax consequences are on something that they think is a secondary or tertiary issue like purchase price allocation. And we'll often start with putting in the LOI that the allocation is going to be at fair market value. We then see a response coming back from the sellers at net tax value, and then we'll settle in the middle at, which is often net book value. Doesn't work all the times. I think a lot of it depends on the advisor. Sometimes sellers don't have their attorneys involved. They have an advisor, but it's a smaller business. They don't have an attorney involved at that point. And so we've had a little more success getting a favorable outcome at that stage.
Something that James said before, selling the business to a corporate. We've also done a couple corporate carve-outs. So we bought business from corporates. Again, they don't seem to care as much, or it's so complicated. They have tax. Their tax situation is much more complicated than mine's going to be. So their fight over the purchase price allocation usually isn't as strong. Now, definitely going to be exceptions to that, but it's really going to be more. And what hurts, when we delay, particularly a founder or a family-owned business, when you delay that, then they finally get their accountant involved. Then it becomes an issue, and then as Nick said, you're too late, and it's kind of becomes a big issue. So we try and be upfront about it and just get good people talking about it so we can solve it pretty quickly, because it is a huge economic issue for both sides, or it can be.
Have you ever had situations where you had to flip a 338H10 to an F reorg halfway through the deal negotiations?
Yeah, I've had that situation multiple times where the sellers did not get good advice at the LOI stage and thought that they could get rollover treatment on the equity that they were going to invest in the new company through a 338H10, in which case 100% of the proceeds on that sale are going to be taxed as an asset sale. And so, midway or sometimes later during the process, 3/4 of the way through the process, we had to flip it to an F reorg, which then it's a whole, explanation and education to the sellers about what it is. And we deal with a lot of lower middle market companies where they might not have sophisticated advisors and legal representation. So that's caused some complications in our side, at the buyer side, having to do a lot of the work that the seller should ultimately do. But economically, it was so advantageous to us, and the deal wasn't going to get done unless we were able to accomplish that.
Thanks. And I know something we get a ton of questions on, and certainly do a decent amount of analysis around, is qualified small business stock, so otherwise called Section 1202. And what Section 1202 provides is for an exclusion of gain on the sale of stock to its shareholders in an amount equal to the greater of $10 million or 10 times the basis. So it can be pretty significant. And it's been around since 1993, 1202, but really gained popularity again when the Tax Cuts and Jobs Act of 2017 dropped that corporate tax rate down to a flat 21%. And now folks didn't mind so much being in a corporate structure if it meant they were going to get to take advantage of QSBS on the back end. So curious to hear if you guys have been able to take advantage of QSBS on any of your exits, or are you structured in a way where you're going to, and what that looked like for you?
Yeah, I could start. First, I wish I would have learned this a while ago, because there's a couple exits that would have been very nice to be able to shield that. And but as Nichol said, I think it really became popular after the tax cuts, 2017 or whatever you just said. And so it took a little while for it to materialize. And there's a couple different factors to it, but just you have lower taxes because it's probably like 8% lower than the LLC tax rate. We previously, as independent sponsors, did LLCs, and I'll get to another problem with LLCs. But the C corp structure just makes it a lot simpler, right? It's lower tax rate, so annually we're paying less in taxes. No K1s, which I'll separate that, but. I don't know, depending on your investor type, I'm getting calls in March, when's my K1? And I'm thinking, I'll talk to you in August. That's when we're going to have your K1. So it's just, it just cuts all that out. But obviously the big savings is if you hold it for 5 years, not paying the corporate or the capital gains tax up to 10x, which if all my deals did 10x, that would be a good outcome. So
You're not getting more than 10x?
Well, but the ability, because really they work for asset transactions, correct? And so we're really doing that with S corps and or LLCs, and obviously not doing C corps. And so we've been with we haven't done it with corporate carve outs. We were too late to that party, but we've been able to do it with more founder type transactions through F reorg, and then converting it to a qualified small business under than $50 million transaction size. But it's that trick, I think Nichol can jump in here, but the trick is to make sure it's original issue securities, which is usually some sort of asset type structure that's required. But we've done it now twice. We haven't held them for 5 years. All those kinds of things. We're kind of weighing that out. It also kind of gives you, kind of forces all from an investor perspective, from an independent sponsor. Got to wait 5 years, so there's a big incentive to have a little more time period to let that investment mature. The other thing, and we were talking about this before, and Nick and James and others can jump in here, but getting out of the LLC distribution tax situation I think is a positive, because James here has never done a bad deal, so or Graham, sorry, and James have probably never had to worry about this. But if your business gets a little tight, banks don't really like to see you make a distribution, even though it's for taxes. And so the C corp structure kind of eliminates that, because obviously the company's on the hook for the taxes as opposed to the shareholders or unit holders. And so that's been a little added advantage of the C Corp 1202 qualified small business structure of going back to C Corp. And then James said this a moment ago, but a lot of corporates, a lot of private equity, when you sell, you have to sell a C Corp. So they don't get a step up, but most of those groups don't care that much. And so you're probably not giving up much.
In the case with that, like Peninsula, where you have a committed fund, if we have LPs that are ERISA entities, so pension funds and insurance companies, we need to have a C Corp blocker in the ownership structure someplace. So for years, we've had cases with independent sponsor-backed or led transactions where we've had some tension. We wanted a C Corp blocker. The independent sponsor did not want a C Corp blocker because they wanted kind of easier access to interim distributions and a differential on the tax rate. That tension with 1202 has really went away. Once we explained to them, hey, there's an opportunity as long as we meet all the criteria going in and we hold the stock for more than 5 years, as an individual, you can qualify for a capital gains exclusion. It's really made that part of the transaction frictionless. And even for us as a fund, while our LPs don't qualify for that treatment as institutions, the partners in the firm, myself included, we do qualify for that. So it's been, it's really been it's been good kind of on all sides of the transaction.
It does create an interesting dynamic from a fund perspective, because our promote benefits from that tax treatment, but our LPs typically don't.
Yep.
Well, I can speak from real-time experience. I was explaining to both James and Jason earlier that of our 3 deals, 2 of them have a C Corp blocker in it. The third does not, and that one is kind of the double whammy of one, it had some cash flow problems. The bank wasn't happy. We're in covenant default, so they're not letting any distributions go out. At the same time, the nature of that business suffered from the change in the R&D. Was it 5? I can't remember the number, but suddenly our tax exposure went up massively, regardless of what the entity structure was. At the same time that we couldn't make distributions, and that was kind of regretting the structure now, but in hindsight. And then the only thing I'd say on the small business, qualified small business tax, Nichol could speak much more articulately. There are lots of requirements you have to meet and boxes to check. I worked on a deal where we were trying to do all sorts of gymnastics to fit within those boxes, and ultimately determined it was you had to squint really hard to kind of feel comfortable about it going in, and also the sellers had to take on some incremental risk the way we were proposing to get around it, and we moved past it. But it's the sort of thing you can, burn a lot of brain cells on. So I'd say just be mindful of that before you start down the path.
Yeah, and I would just add that that's an opportunity for insurance to play a role, or it could be an opportunity for that to play a role. Obviously, having a tax advisor sign off and say that this, is sufficient and a good plan of attack is necessary, but the complexity of it and what needs to be followed and the rules and the ongoing maintenance of it is certainly an area where we see people decide to spring on a tax insurance policy protecting that specific tax risk for 7 to 10 years, depending on what's purchased. So moving forward, they've got the peace of mind of knowing, and even at exit, that this business is protected from any sort of challenge from a tax authority.
Nichol, I have a question for you on this.
I can't wait, Grant.
Let's say you stick with the C Corp. Tax rates are low today. They have not always been low for C Corps. One may argue they may go up in the future. Are we just stuck?
I don't know. I don't have a crystal ball. I'd be a bad tax advisor if I gave you an answer to that. But I do think that we've had a lot of conversation about this, right? Because as we're helping people that come to us and say, should I form an LLC or a C Corp? Hey, yes, rates could go up. Today, QSBS treatment is available. We would hope and presume that you'd be grandfathered in if you structured into a C Corp. But are you stuck with a higher tax rate? I don't know how you'd kind of get around that. So yes, something that certainly will be interesting to see how things unfold. And then again, I think we'll get back to modeling more of the benefits out. So in the past, right now, it's kind of a shoo-in, right? Like 21%, I don't have to pay tax distributions. So the cash flow is better as well. And then I get this great exclusion on the back end. But if now that rate becomes 28, 31, something, it could change again. Because again, This has been around since '93, but we didn't see a lot of folks taking advantage of it until, and there were 50% exclusions that then jumped to 75. Now we're at 100% exclusion. So it'll be interesting to see how the government plays with even the percentage that you can exclude, which is right now 100%. But for right now, what is pretty interesting is that, yes, there are requirements that you has to be a domestic C corporation at the time the stock's originally issued and at the time the stock is sold. It has to be worth less than 50 million, could not have exceeded that amount for all of its history up until the time of the original issuance of the stock. It does have to be an individual shareholder or a pass-through, so another C Corp exiting can't take advantage of that. And then, it has to, at least 80% of the assets of the qualified small business have to be used in an active trader business. So we have to be pretty cautious if we're thinking holdco. Now, there's some look-through provisions for a C Corp that owns subsidiary stock. Nothing at all mentioned about its interest, C Corp's interest in partnerships. So I think we would look to, are we at 50% or greater holdings, and what's the activity of the board members of that corporation as it relates to that trader business, and does it make sense that they're sort of actively participating? So, on a case-by-case basis. But to your point, James, or Jason, sorry, it's that original issuance can be deemed completed with just the conversion of an LLC to a corp. So they're like, wow, I'm in an LLC. I really wish it was a C Corp. Totally cool. You can check the box, or you can incorporate that LLC, and that is considered the original issuance, presuming you meet all of the other qualifications. And I will say one that gets completely ignored, and maybe this was the issue with your transaction, is the trader business itself. So we jump in lots of times, and folks are like, oh, I have QSBS, or I'd like QSBS. And we're like, hold on a minute. What are you going to be doing? Because the code section is only about this big as it defines that, but the tax court cases are pretty voluminous. And, the way the IRS has broadly defined something such as a broker, this is a real life, tax court case, and it was a chief counsel memorandum. We had a tech company that created a technology whereby it matched an end user with the service provider, and the IRS came in, think Airbnb. That wasn't the taxpayer, but the service came in and decided that they were a broker under the broad Merriam-Webster definition of a broker. So nowhere in 1202 is broker defined. Lots of times we really get into that 1202 analysis up front, because we'd really hate to see anything put into a corporate structure if we can't get QSBS anyway, because getting it out, as you know, if it's appreciated, triggers gain. So I think that's pretty much it for me. I know you guys had some things you wanted to comment on, and Andrew, I don't know if you've got any additional comments on how you can protect in the case of a step up or those tax benefits we've been talking about.
Sure. Yeah, it's those scenarios, right? So, and kind of almost to the last point, right, where you've kind of said the IRS section is this big, but the court filings are this big. So it's the peace of mind that you're doing this the right way. A tax advisor, again, has signed off on it, but certainly some material risk if there was a adverse opinion on it. So those items are big. I know VAT, sales tax, that came up. Transfer pricing has come up already too. So my goal was just to kind of give you guys awareness, because attorneys are catching up, tax advisors are catching up, and really, it's kind of interesting too. When this is brought up, or when there's in a deal setting, when there's a tax exclusion or whatever, you're relying on those advisors to think of this stuff. So I would just say, as investors, that this is nascent enough to kind of keep in the back of your mind. And I think also on the offense, it's something that you could kind of consider too, where other bidders on deals might miss this element of it from a risk mitigation standpoint to feel comfortable moving forward. And then it's not just in the deal setting, right? So your existing portfolio of companies, to the extent you've got a tax issue or a tax uncertainty that you're looking to feel better about, or just need to protect, or are thinking to exit the business, we've seen those sort of situations drive people's interest in tax liability insurance. So those would be the only things I think I would add, just kind of broadly speaking. But
yeah, there was, I lied. There was one other question I had for you guys, and it's about rolling your fee. So have you had experiences where were able to roll your fee, not recognize ordinary income, and get cap gains treatment on the back end? And could you share with us how you did that?
I'm happy to take it. We've done that in a couple of our deals where in order to avoid having dry income on stock you take as consideration for your closing fee. We've taken it in a security that sits behind the other equities. So if you turn around and sold the business the next day, theoretically there's no value in that, so there's no tax implication on the day of closing. And then the trade-off, of course, is there's that hopefully narrow band of risk where at exit, no value creation in the business or very little, and your stock is still worthless. I think we came to the determination that we believe in this business, obviously, so we're really underweighting maybe the likelihood of that outcome. But for us, it was kind of a no-brainer to not pay tax today on these securities.
Nick, when we were an independent sponsor, we did the exact same thing, and for us, it was easy math. If it's a $10 million equity check and your fee's $500,000, and the waterfall, you're subordinating your fee to that $10 million. If we couldn't create 5% value, it just seemed like it was a bad investment over 5 years.
We don't deserve it.
That's right. And if you look at the amount of equity you get investing on a pre-tax basis versus post-tax, it's material. So you're getting more equity as a result of doing it that way.
That's universally the way that we've seen it done. Every independent sponsor that wants to have a tax advantageous